outlook for the new year still. A very big story this week, and the country director for International Finance Corporation, which is the private sector lending arm of the World Bank, Essien, had a lot to talk about. In particular, those 4 pillars, what she considered as the needed, what Nigeria needs to do, to put it simply, to get inclusive growth. We've done GDP in very big numbers in recent years, but haven't been able to drill down and become inclusive, bringing more people out of poverty. So how do we redress the GDP growth into what you call an inclusive growth? MLO has some ideas from the International Finance Corporation, and she shared them at the Deloitte Outlook for 2020. Take a listen.
We must be relentless about pursuing inclusive growth. We must be absolutely dogged about this. That is why it matters. It matters because of the impact that this has on people and their everyday lives. At IFC, we believe very, very strongly that the private sector can deliver on an inclusive growth agenda, particularly in a place like Nigeria, where the private sector is incredibly dynamic. And we believe that you have to put the private sector very squarely in the middle of delivering on an inclusive growth agenda. It's not government that will deliver on that. It is the private sector that will deliver on that agenda. But again, we do want to spend some time talking about policy aspects. So the question is, what needs to happen? We don't think there's a simple solution, but we do believe that boosting productivity will accelerate growth and help create more and better jobs. So if you had to characterize it in a very simple way, again, there's no simple solution, but if you had to characterize it in a simple way, we've done it this way: focusing on boosting productivity, and that being the accelerant for more and better paid jobs. So from our perspective, all policy should be designed with this objective in mind. This graph is one way to look at the productivity situation in Nigeria. It's a graph of labor productivity against the main sectors in Nigeria, agribusiness, industry, and services. And as we can see with the red lines there, Nigeria is far away from its aspirational peers. There is a lot to be done, and those aspirational peers, many of them are in Africa, but also in Asia as well. So there's a lot that needs to be done in order for Nigeria to really bridge this productivity gap. So we see 4 key areas where reforms will make a real difference in achieving an inclusive growth agenda in Nigeria. The first being policy transparency and predictability. The second being input quality and availability. The third being reduction of regulatory discretion, and the last being access to finance. So these are key pieces of the puzzle, and I think all of you probably have something that's top of mind for you that would go in any of these buckets. But let's focus first on policy transparency and predictability. And for us right there, the key thing is monetary policy effectiveness. And what does that mean? Again, there's a long list of things that one can put under that title, but for us at IFC and at the World Bank Group, for us, number one, evaluating the effectiveness of development finance interventions and import substitution policies. Key thing to address under that one. Also, the perennial discussion around unification of the exchange rate into a single window. That remains an objective that I know the government also is pursuing as well, but still has eluded us for quite some time. And then also strengthening the banking resolution framework. Those are just a few that I think come under that bucket. The second one, domestic revenue mobilization and expenditure quality. Key one as well. We've seen in the last couple of years quite a bit of progress in that regard, at least efforts on the part of government to move it forward, but not as much as we'd like to see in terms of results. A key one there is going to be increasing non-oil revenue through comprehensive tax policy and administration reforms. I always like it when people have the debate around why Nigerians don't pay taxes, how we can get Nigerians to pay more taxes. This goes back to the question of the broken social contract that desperately needs fixing in order to move this agenda forward. I think we all know that Nigeria is in the lowest ranks with respect to revenue as a percentage of GDP, although there's been some small improvement recently. And then under the third bucket, under policy, transparency, and predictability, we have trade policy. And there, I'd say top of mind for us is phasing out foreign exchange restrictions and import prohibitions. Not because we think that some of these things are bad things, but simply because they tend to be done in a way that isn't consistent with a longer-term objective. So they're done maybe as a knee-jerk reaction rather than a part of a holistic plan to move a sector forward, to increase, for example, a domestic capacity for manufacturing. So that's the first bucket. The second one is input quality and availability. Now, this is also an important one because this is where infrastructure comes into play. The first one being power and transport infrastructure. I think many of you have seen statistics around the cost of movement of goods within Nigeria and then from Nigeria to other parts of the world. Really depressing, frankly, at the end of the day when we think about how much it costs to just move things around within the country. In addition to power sector reforms, and we could spend 2 days talking about that, but let's assume that that's the key one to get done. We also see a need to establish a framework for well-managed PPPs for roads and railways and airports, and also, importantly, to improve land management for investment in agriculture. And our belief is that the failure to address these land management issues, and I know this is done at the subnational level, is probably the biggest deterrent to investment in agriculture in Nigeria. The second one here is human capital. A couple of years ago, the World Bank Group produced a Human Capital Index, where we basically measured countries against their ability to invest in young people and then what it takes for them to get to a place where they are productive adults, where they can actually contribute to the economy. Nigeria did very badly on that index. I think many of you saw that. I think it was 152 out of 157. So very, very poorly. And for those of you who remember Nigeria from the 60s, you would be very hurt by this statistic because there was a time when Nigeria was leading the way in terms of education, for example, across Africa. So this one is a key one, and I always like focusing on this one because, again, it's about people. And for me, you have to start with people in order to get anything right. One of the key things we'd like to see here is an implementation of a national skills development strategy that would then align the supply of skills with the market needs. Last, I would say on this slide would be trade facilitation. There, we all know the stories there about the costs and the issues at the ports, at the borders. That one I think is well discussed again and again, a key one that needs to be addressed. The next area, reform area for us is around the reduction of regulatory discretion. All of you will have felt the pain of that, I think, over the years. This is an important third piece of the puzzle. You're in business, so you recognize that if you don't have clarity around what needs to happen in the near term, in the future, or you don't have an expectation about what government will do, then for you it's very difficult for you to invest. Again, so there's a laundry list of things that could go under this bucket of reduction of regulatory discretion. But essentially, we've captured them all around transaction costs and really trying to level the playing field for investors. So they're easy things. I think there's some things that are low-hanging fruit in that area. You have the adoption of the company's Allied Matters Act as one, digitizing regulatory processes, another, strengthening the capacity of the competition authority. There are a number of things that could go under there that ultimately will address this issue of reduction of regulatory discretion. When we think about Nigeria, we know that we have weak institutions, and this is where this really comes to play.